All right. So this is going to be a Wyckoff on the euro, where I'm going to show a turning point. Um, there's one here on the euro up here, but let me see if it's clear. Uh, I mean, this is not enough distribution. So over here, I mean, you see the pullback and then pressure came in. So this one's a bit hard. What the hell is this? Anyway, this one's a bit hard because this is a different type of turning point. You know, you have this is the climax type. So what happened here was right here you had a buying climax. You could tell because the climax is bigger than a lot of prior waves, and it was followed by selling. So this is one type of turning point. All right, this is the type of turning point so, where exhaustion is identified by a climax. Now, that's what happened. You see that high volume right here? And then you have your volume off the top, which is right here. It's the biggest up volume is 100 bricks. But the problem is it didn't come back to test. So, I mean, what's the point of going over this thing? But I just wanted to explain how this turning point occurred. This turning point occurred because the market tested the breakout on a higher time frame. When it tested a breakout on a higher time, what happened? You had a buying climax right here. Yes, you had test and whatever. You had volume off the top right there. And that volume off the top was part of a selling wave. That selling wave was right here. And that selling wave is basically your change of behavior. And after that, what happened to the volume? It dipped off, which means what? It confirms that buyers are exhausted. That's all it is. I don't know what I put lack of demand. Where this one has two, this one has two, this one has like zero, very little. So, and then after that, you have your confirmation. A problem is after you have your confirmation, a lot of times these trades, they don't come back. So you're not going to get a pullback. In fact, this was so bad that it didn't even come back to, it just had like two bricks. So this is pure weakness. All right. So anyway, that's not the one I wanted to go over, but many times you have this situation where you're just not going to get an entry, and unless you take a lot of risk, and you have no choice but to do the breakout thing, which is uh, draw your trend line here, and the hell, and then you're gonna have to take the short on the breakout, and that either has a lot of risk or has the risk of getting stopped out, depending where your stop is. Anyway, that's not the one I want to go over. I'm going to go over here, this turning point, which is a better one because you can see it better. All right, let's go over this. So you see that again, you have selling here. So this is going to, first of all, is it testing a breakout or a breakdown? And it is. It's this break right here. It's going into that, like right here. All right, and you have pullback sellers. So we have to take a look at the situation. By the way, this might be uh, going up. So don't think that this market is getting ready to puke. It might test and go up one because it hasn't. There's still a lot here that hasn't been tested. So it might do a one, two, three up. So just Anyway, over here, where's the exhaustion? The exhaustion is in the form of shortening of the thrust. So you have your shortening of the thrust, you have it right here. All right. There is some additional volume right here, meaning I wouldn't call it a climax, but it's like it's more than the prior waves, and it gives less thrust. So I don't know how to classify this behavior, but it's basically a shortening of the thrust on a climax, but the climax doesn't have that much volume. I don't know what it is called, but I know the purpose of it is for sellers to get short. Because if you take a look at this from high to high, it's like 1 or 2 bricks, right? So, and this volume increased, but it only gave 1 or 2 bricks. Why? Because it's being used to establish short positions. Anyway, so here we have your shortening of the thrust on the left-hand side. What else do we have? We have, of course, right? There's a lot of cause. Now, in that cause, it's very important to see what's going on. From the top, you have high volume because this upthrust, this attempt to go higher is being rejected. This is a very important behavior. This is volume off the top. All right. This is like the nail in the coffin. This is making the case for a downtrend extremely strong. When you have volume off the top and you have a change of behavior, it's game over. All right, that is it. They've established, they're saying we are not going up any higher. All right, now there's a lot of different, this is volume off the top, that's what it is. All right, you may call it an upthrust. Yes, it's an upthrust, but it's an upthrust that goes up with a lot of volume going back down, and it initiates the change of behavior or the selling or whatever here, sign of weakness. And how do you know it's a sign of weakness? Obviously, you know, but because of the distance, 7. That's bigger than all these waves. So this is a sign of weakness. All right, so now you're on the right-hand side, and what do you know what to look for on the right-hand side? A lack of demand. Where's the lack of demand? It's here. This one is very little volume. This is some effort here, but here it's pretty evident that this is the smallest amount of volume in a lot of waves. It's smaller than basically a lot of waves. All right, so. And this also from a perspective of distance, meaning the fact that it's only 1 brick can also be considered to be a lack of demand, especially when it makes a lower low. And now what do you have? You have markdown. So this market right now on this time frame is in markdown. Done. All right, thank you. Bye. All right, so what I'm going to be doing is just applying some Wyckoff turning point stuff that I've been going over on this turning point right here, and just showing some of the behaviors, but in a lot of, where the hell is it? Not this one. I think this one, yeah. All right, so let's go through this. So as I explained earlier, basically you have, in any turning point, you have 3 things. You have you want to break it down, right? So a turning point. And what do I mean by turning point? Basically a pivot. So you have this, and it goes down, and you go this, then it goes down. So what is going on? Let's say this is a higher time frame. What is going on right there? What is going on right here? What is going on right there? These spots have distribution and accumulation in them. They have to. The only way you're going to turn a market that's going down up is if the force of the buying overtakes the force of the selling. And the only way if you to do the same thing on the downside, meaning the take market that's going up down, is if the force of the selling overtakes the force of the buying. And that typically is a process. It can be a process, and that's a distribution process. And the force of the buying overtaking the selling is the force of the accumulation process. And that's what creates these turns. Yes, these are minor reaccumulation and minor distribution that turn these swings, but on the lower time frame, these are entire trends down and entire trends up. So it's just a matter of time frame. I understand that typically you might be seeing this whole thing, say, okay, this point and figure going up and down, ding, ding, ding. And then you have markup, and then what do you have? You have your distribution, and then what do you have? You have your markdown, and you have all these schematics that go in the middle and all that. Okay, great. But you have, the idea here is to apply that. And you don't need to wait on a daily time frame. They can be done, these things occur on smaller time frames all the time. All the time. And I'm just going to show how it's occurring at these points. So this is one swing point right here. I'm taking a look at the left-hand side of the euro, and you see this 1 and the 5, the 0 and the 1 and the 5, where you have pullback sellers. And I'm going to show how the force of the selling overtakes the force of the buying, and distribution occurs. All right, so let's this is pretty obvious. I mean, it's a much longer distribution. So, okay, so now I understand that a lot of folks use this online schematic, right? You see that climax, secondary test, etc., 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 right? So, you have to be careful with that, because a lot of it is just hindsight, and it's a model, which means yes, there are key behaviors in it, but the way it's portrayed is incorrect, in that it's a sequence. So people keep taking a look at it and turning it into a sequence and try to forcefully label a chart based on that sequence. That is incorrect. I mean, it's just that simple. You cannot look at a chart and in hindsight label climax, secondary test, or climax, automatic rally, secondary test, then looking at your sign of weakness, and then taking a look at your upthrust after distribution, UTAD, and all of that. This is not helpful, and the model was never intended to be used as a sequence of A, B, C, D, and E, because markets are too dynamic to follow that entire sequence. Sometimes you'll have a climax, sometimes you won't. Sometimes you'll have a UTAD or upthrust after distribution, sometimes you won't. So, and that schematic also doesn't mention volume off the bottom and volume off the top. So these are very important Wyckoff behaviors. So it's to sequence it like that, and a lot of times what you see is these climaxes, but those climaxes are not climaxes. They're just labeled as climax, secondary test, and they're labeled incorrectly, by the way. Anyway, so make a long story short, I'm going to be going over how it's actually done here. And okay, so from high to high to high. The first things first, though, you need to take a look at your higher time frame, and there needs to be trend and what's the second thing? Level. Don't even think about applying all of this if there's no trend and level. because you're going to go into an area of randomness, an area that just is doesn't make any sense. All right, and just spinning your wheels. So you need the high time frame trend, and you need a high time frame level. What levels? Either a test of the breakout or a full test, meaning it goes all the way down. So for example, like this, let's just show all the way down at that level. What people might call nowadays, I think, order block, as it tests an order block, or a test here. Where's the damn thing? Right? So this is a test of the breakout, and that deeper test would just be testing the low. Right? So it's like a full test. It could also, a third situation would be like, it would be in a spring position. So these are the three types you will typically see. Right there. Where it just got sprung. What are these things doing? All they're doing is one is a breakout, the other is deeper in that it tests the order block or the low, and the other is just goes even more deeper and does a spring. It's really all just measuring the amount of pullback. And what do all these three have in common? Typically at this level, there's some high volume. So over here, at the test of the breakout, you have breakout on high volume and it's testing it. Over here, you have a quote unquote order block, which is testing it, and typically that has high volume. And over here, there's also some type of high volume situation, or like it runs stops, which creates high volume. So it's just amount of pullback into an area of high volume. A lot of times this spring over here will have high volume, like right against this area. This area will have high volume and it'll test, go up a little, and then come back to test. And sometimes it'll test the breakout, go up a little bit, and then the third leg will come all the way down to the order block and test. Right? This is just the term order block, but I mean, it's just, for me, it's just testing the low. You know, right there, testing the turning point here. Anyway, so you need, well, the point I'm trying to get across is you need trend and you need level. If it's not a trend and level, don't even look for it, because you get it lost in the area of randomness. And also up and down is just going to tire you out. So for example, this area here on a higher time frame is the area where the market broke and is testing now. So this is meaningful. This other area here, and I'll draw it, is testing the breakout. See, the breakout was tested there. And, you know, so you need high time frame trend and you need high time frame level. The trend does two things, and this is why you trade with it. One, it increases the probability of success, and two, it gives you a larger reward. Why does it do that? It increases the probability of success because you have traders, more traders that are on your side. In other words, you have the same time frame traders that are on your side, and you have a higher time frame traders on your side. So you have those two groups, where if you're counter trending, you don't have two groups. You're just taking an opportunity off the lower time frame, even though the stronger hands on a higher time frame are against you. That means the probability of success decreases. So when you trade with a higher time frame trend, you're adding the participants from the higher time frame on your side, automatically increasing the probability of success. 2, in any trend, in an uptrend, the up waves are bigger than the down waves. In a downtrend, the down waves are bigger than the up waves. If you're trading with trend, you're trading with the side that has the bigger waves, automatically increasing your reward. Okay, that's why it's important. Those are 2 reasons. Anyway, you have trend and you have level, and that level is typically an area where you had participants involved, and that's indicated by high volume. Because high volume is measuring, is identifying large participants. It's the footprint. It's the footprint of the CM is large volume. All right, now, so we come back to test this area. I'm going on the higher brick size on the left-hand side. You see this? Right there. Okay. And you see this high volume print right after, by the way, this big red over here, big red black right here. That's because they entered. They distributed in that block. And I'm showing on this lower brick side, on the right-hand side chart, that distribution, that this higher time frame shows that big red, big volume. So I'm showing that, and why it's big volume is because distribution occurred there. All right, I don't want to overdo it, but okay, here you go. So you have this, all of this, and I understand there's a schematic and you go crazy with it and try to apply it, but basically everything has a start and an end. All right, everything on the planet has a start and an end. So just like a distribution process, accumulation process, a market process, everything has a beginning and an end. So the beginning I call the left-hand side. The left-hand side, and then what I'm referring to here is the distribution. So the right hand and the end I refer to it as the right-hand side. Right-hand side. All right. So I'm going to indicate what is happening in the beginning of distribution, what is happening typically in the middle of distribution, and the end of distribution, what is happening at the end of distribution. So start, in the middle, and at the end. That's what I mean when I say left-hand side, the middle, and the right-hand side. And what happens after the right-hand side is done? Very straightforward. The market goes into markdown. And if this was accumulation, the market would go into markup, because the right-hand side indicates the end. End of what? In this case, distribution. So I'm going to look at the left-hand side is the beginning of distribution. The right-hand side is the end of distribution. And between the beginning and the end, we have some key behaviors which separate the left-hand side from the right-hand side. So now I'm going to go over what those behaviors are. And also note, like, even though I use indications, right, I know that indicators do not work. They are random and must be combined with judgment in order to for them to work. I've tried other things, indicators by themselves. They do not work. Indicator-based methodologies just don't work. You must apply judgment, and the reason is there are too many behaviors and variants that need to be sequenced in order to make that judgment, and in order to say yes, this market is going down or up with high probability. That's a side point. Now let's take a look at this. So for the left-hand side, typically you get either climax or you get it SOT, shortening of the thrust. Now here's the thing. What is this all equating to? All it's equating to is the demand is being exhausted. the demand is being exhausted. All of that, all those behavior, whatever, indicate exhaustion. So you need evidence that demand, because this is right now an uptrend, right? Higher, higher, a little higher, higher, all that. You need evidence for exhaustion. When the market is exhausted, second thing that happens is the other side. The other side needs to show strength, meaning that it's not exhausted. It's stepping in because of the exhaustion. So demand needs to show that it's exhausted, and supply needs to take advantage of that exhaustion by indicating the strength of supply. And that is indicated by your sign of strength or your sign of weakness. The sign of strength and sign of weakness come after the other side is exhausted. All right. And then finally, step 3 is confirmation of exhaustion. This is the conceptual framework for any turning point. Forget all the other stuff. This is it. So in this uptrend, what needs to occur? Demand needs to prove that it's exhausted. Supply needs to show a sign of strength, or what is a sign of weakness. Basically, it's the strength of the supply, all right? That supply is there and it's strong. And after it does that, demand needs to confirm that, yes, it's still exhausted. Once these 3 things happen, you have the situation where supply is greater than demand, and it's confirmed. Because exhaustion is basically weakness. It's weakness in demand, strength in supply, and confirming weakness in demand. That's it. When you hear people, this saying about when supply is greater than demand, market go down. When demand is greater than supply, market goes up. It's very easily said, but explain to me what that means and how it's done. When supply is greater than demand, it means that supply is strong and demand is weak. Demand becomes weak because of exhaustion and confirms that it's weak also. Whereas supply is strong because of a sign of weakness, because it shows an indication of its strength. So when you pair those 2 things together, you will get a turning point, or you will get direction. Direction, let me explain this even deeper. Direction, let's say down. Direction, let's just use, when supply is strong and demand is weak, you get direction down. When demand is strong and supply is weak, you get direction up. How do you prove demand is strong and supply is weak? Weakness, what is weakness? Weakness is the result of exhaustion. Weakness is created by exhaustion. Strength is created by a sign of weakness, a sign of weakness or a sign of strength, which is just a big wave. That's all it is. All right. It's also known as COB, whatever, or change of character. It's all the same shit. All right. So Now the weakness plus strength creates direction. This is common sense, but nobody has been able to explain the behaviors around weakness. The behaviors, behaviors here for weakness is what? What is the behavior around weakness? Weakness is indicated by a climax. It is indicated by a shortening of the thrust, and it is indicated by a lack of demand or a lack of supply. Those are the key behaviors, and they need to be sequenced together. So, strength is indicated by a change of behavior, sign of strength, sign of weakness. So now, when you see that and you are able to detect that, you're able to detect a turn. All right. Now let's apply that. And I've given the history lesson. So here, as you see, it goes to a, remember, the trend is down and we're at a level, okay, of the high time frame. Now, when we're at that level, start applying it. The first thing I see, I'm looking for demand to show weakness. Okay, all right, or and in the form of exhaustion. So it comes in two forms. Here we see shortening of the thrust. Bang, right there, shortening of the thrust. But that doesn't mean that the market is going to turn. Okay, there has to be weakness and strength combined. All right, because all it could do is just go to support and then rally, right? So the shortening of the thrust is there. How do I know? Well, the from high to high to high is getting smaller. So yes, it is shortening, but by itself means shit, nothing. Then it starts going sideways and it's building cause. So the uptrend is now going sideways. All right, that's important. It's not, where's the momentum now? Is it taking a break? All right, now as it comes to the same resistance, you have a key behavior, which is that attempt to go higher that gets rejected. What is that? That's your volume off the top. All right, so now you have a shortening of the thrust, you have an attempt to go higher, you have volume off the top. So there is a degree of weakness, there is a degree of exhaustion. That exhaustion is indicated by the shortening of the thrust, and the other side now wants to show its strength. So how will it show its strength? Heavy volume and big selling. In this case, you see the volume is increasing. Big red, the reds are increasing. And here is their strength. Okay, so this selling from the volume of the top is the strength of supply. All right, so we see that demand is weaker, supply is strong. Now we need a confirmation that demand is weaker, because as supply pushes price down to a support level, demand can come in and rally. And if they do so, it's going to mess up the downtrend, the possibilities of a downtrend. So demand has to confirm that it's exhausted. Take a look at these rally attempts and the volume on them. There's nothing. I mean, the first attempt to rally was only one brick. That's the smallest amount of distance you can have on this chart. It confirms lower, comes up, down, up on even lesser volume. So this is a clear case of a lack of demand. That lack of demand is confirming the weakness originally that we found by taking a look at the chart and identifying shortening of the thrust. It could be from shortening of thrust, or it could be from climax. So I mean, demand is exhausting, supply is strong, demand continues to be exhausted, and that's why you have a downtrend. Done, finished. This market is down. It's going to go down. It's probably going to take out these lows. I mean, it can if now if supply gets if supply gets exhausted and demand shows strength, and then supply confirms that's exhausted, what do you think is going to happen? It's going to go up. So this is how you read supply and demand. All right. If you want a formula, I can give you a conceptual formula. So basically, oh shit, I don't know what I did. All right, I don't know what I did, but that's it. Weakness plus strength plus confirming weakness is going to do that. And how do you get weakness? You get it in terms of what? In terms of exhaustion. And that exhaustion, what are the behaviors? What are the behaviors of weakness? What are the behaviors of exhaustion? Well, it's basically a climax and shortening of thrust. These are two typical ones. Then what is the indication of strength from the other side that wants to change the trend? That comes in terms of your sign of strength or your weakness, also known as change of behavior, change of character. And after that, you confirm weakness or strength using your lack of demand and lack of supply. And once that's there, the market will turn. So this is the turning point. All right, take care. And over here, you see something similar. What is this? This is interesting because this is a different example. This time it got exhausted because of what? Climax. Right there. How do you know? Look at the high volume that comes in. The high volume. Do you have some testing? Yes, you have testing after that, secondary tests. On a very minute scale, but you have secondary tests. You know, you went up 9 bricks after that, only 1. And the other thing to note is this behavior here, where you go up, down, up, down, up, down. This is typically this typically marks the end of distribution, but that's another point. All right, after that, you have selling. What is that selling? This is your indication of supply. What's a sign of weakness. Now look at the demand after this climax. This climax is exhausting, but you don't know, because once the selling came and tested the support, you can have demand pick up and make even a higher wave that has 10 bricks instead of 9, right? How would you know? So it needs to confirm the exhaustion. I'm looking for confirmation of exhaustion here. What is the confirmation of exhaustion here? Take a look at this demand. It went from what number this is? 13,000 to 5,000 to about 2,500 to I don't know what this is, about less than 2,000. So 15,000 down to less than 2,000. This is confirming weakness. This is confirming weakness. Therefore, it is your lack of demand. All three pieces are there. Direction is created. And that direction is down. Done.